The stock market is a timeless investment strategy, and even though stocks don't just go straight up, it's always been touted as a smart place to store your money. But 2025 flipped that on its head, as new tariffs, wars, inflation rates, and super bold claims by this guy led to the S&P losing over 10% in 2 days, making it the second worst 2-day period in history. Here's why it's just the beginning, and we may be preparing for something even worse very early next year. Welcome to Home of Finance, where we break down all the most important market information the news refuses to tell you. If you find this breakdown valuable, hit that subscribe button now to stay ahead of these market-shifting events before they happen. Let's start with what lit the fuse in late 2025, Trump's tariff blitz. After winning the 2024 election, Trump promised a tariff revolution, and boy did he deliver. By March 2025, he slapped a 25% tariff on all Chinese imports. We're talking about a comprehensive economic blockade. China didn't wait to retaliate. Within 48 hours, Beijing announced matching tariffs on American exports, specifically targeting agricultural products, aircraft, and semiconductors. The EU and Canada followed with their own defensive measures. The immediate impact? Supply chains that were already fragile from the pandemic completely unraveled. Inflation jumped 1.2% in just 1 month. Companies like Apple saw production costs skyrocket 18% practically overnight. But what's coming is even worse. Trump's America First 2.0 plan, scheduled for February 2026, aims to raise tariffs to 35% on all imports from any country that runs a trade surplus with the US. That includes Japan, Germany, South Korea, critical trading partners. Morgan Stanley analysts project this could wipe $2.8 trillion from global GDP in a single year. JP Morgan called it the single greatest threat to market stability since 2008. When markets sniff out economic disaster, they don't wait for the damage to materialize. They price it in advance. And that's exactly what we're seeing now. Remember when everyone thought inflation would magically disappear in 2023, then 2024, then 2025? Well, it's now Q2 2025, and inflation is stubbornly sitting at 4.1%, more than double the Fed's 2% target. The Federal Reserve is trapped in policy paralysis. Powell's December press conference was a disaster. His statement that we cannot rule out additional rate hikes in 2026 sent markets into a tailspin. The 10-year Treasury yield shot up to 5.7%, levels not seen since 2000. Why is this so devastating? Because the market had priced in 3 rate cuts for 2026. Markets hate nothing more than shattered expectations. High rates aren't just abstract numbers. They're corporate kryptonite. Companies that gorged on cheap debt during the zero-interest era are now choking on refinancing costs. The data is brutal. Corporate debt defaults jumped 47% in 2025. 62% of small businesses have reported reducing hiring or cutting staff due to borrowing costs. For everyday Americans, it's even worse. The average 30-year mortgage rate hit 8.2% in October 2025. Housing affordability is at its lowest level in 40 years. The Fed's choice is impossible. Cut rates and risk inflation spiraling out of control, or hold steady and watch the economy suffocate under debt. Either way, markets lose. Remember the dot-com bubble of 2000? History doesn't repeat, but it certainly rhymes. The AI sector has grown 780% since 2025. Nvidia's market cap briefly exceeded $4 trillion in 2025, making it worth more than the entire German economy. The numbers are staggering. The average PE ratio for AI-focused companies hit 118 by late 2025. For context, a healthy PE is typically between 15 and 25. We're seeing pure speculation, not investment. Look at these companies. TechVision AI, no profits, $62 billion evaluation. Quantum Neural, 3 consecutive quarters of missed earnings, stock up 210%. Mindframe Technology, 6 employees, $14 billion market cap. This isn't investment, it's madness. The venture capital money tells the same story. AI startups raised $410 billion in 2024 and 2025 combined. For perspective, that's more than all venture funding across all sectors in 2018 and 2019. BlackRock's analysis suggests 83% of AI companies are now trading at valuations that assume perfect execution and market dominance, an impossible scenario when all competitors are operating under the same assumption. The problem? Many institutional investors are dangerously overexposed. Pension funds have increased their technology allocation by 28% since 2023, with AI comprising the majority of those positions. When reality inevitably collides with fantasy valuations, the correction won't be gentle. It will be swift and merciless, taking down not just the obvious bubble stocks, but dragging the entire market with them. Don't navigate this financial minefield alone. Subscribe now and join our community of informed investors who saw this coming. Everyone expected housing to cool off in 2025. The experts were dead wrong. Despite mortgage rates above 8%, home prices rose another 5.3% nationally this year. Why? Simple. Severe housing shortage. New construction still hasn't recovered from the 2008 crash, and existing homeowners are locked into their low-rate mortgages, refusing to sell. This has created a liquidity trap in the housing market with profound implications for stocks. First, the average American is now spending 41% of their income on housing. an all-time high. That's money not going into consumer spending or investments. Second, home equity extraction. Once a major source of investment capital, has virtually disappeared. In 2022, Americans tapped $275 billion from their homes to invest or spend. In 2025, just $87 billion. The cold, hard truth. The stock market is missing billions in retail investor capital. Look at Robinhood's new quarterly report. New account creations down 38%, average account deposits down 22%. Charles Schwab reported similar numbers. The retail investor, who provided crucial market support since 2020, is now struggling to pay rent. Adding insult to injury, household debt has reached $19.7 trillion, with delinquency rates rising for 8 consecutive quarters. The American consumer, the backbone of our economy, is buckling under financial pressure. When consumers can't consume, corporate profits fall. When profits fall, stocks follow. It's economic gravity, and no market can defy it forever. Let's talk uncomfortable truths. Market valuations have defied fundamental logic for years. The S&P 500's forward PE ratio peaked at 26.4 in October 2025, 48% above its 25-year average. The Shiller-Cape ratio hit 38, a level only seen twice before, in 1929 and 2000. We all know what happened next. Markets can ignore fundamentals temporarily, but reality always comes collecting, and the bill is due. Corporate earnings tell the real story. Q3 2025 marked the third consecutive quarter of negative earnings growth. Not just missed expectations, actual year-over-year declines. Profit margins are getting crushed from multiple directions. Rising input costs due to tariffs, higher borrowing costs from elevated interest rates, wage pressures from a tight labor market. The magnificent 7 tech stocks that carried the market for years are showing cracks. Their combined market cap represents nearly 35% of the entire S&P 500. When they sneeze, the market catches pneumonia. Technical indicators are flashing red. The market's advanced decline line has been deteriorating since July, showing narrowing participation in the rally. The VIX Volatility Index has established a series of higher lows, sign of growing investor anxiety. Institutional investors aren't waiting for the headline crash. Goldman Sachs reports that institutional clients have increased their defensive positions by 61% in Q3 alone. The perfect storm is brewing for early 2026. January, corporate earnings season will likely confirm continued profit deterioration. February, Trump's expanded tariff program takes effect. March, Fed meeting where they'll likely disappoint market hopes for rate cuts. April, first major AI companies facing impossible growth expectations. Any single factor might be manageable. Combined, they form a cascade of negative catalysts that could easily trigger a 30 to 40% market correction. This isn't doomerism, it's mathematical reality. Markets don't go up forever, especially when disconnected from economic fundamentals. History has shown us time and again that markets can ignore reality for longer than seems possible, but they cannot ignore it forever. What we're witnessing isn't just a typical pullback or correction. The confluence of unsustainable tariff policies, persistent inflation, tech bubble valuations, housing market distortions, and deteriorating fundamentals points to something much more severe. The recent 10% drop is just the market's first acknowledgement of these realities. Smart money is already positioning for what's coming. Knowledge is your best defense in volatile markets. Understanding these forces won't just help you survive the coming crash, it might help you thrive through it.